Will Ethereum be the trade of the decade? Could Ethereum 100x and even flip Bitcoin? Ethereum is heading into what could be its most explosive breakout ever. Prices are already surging off the lows, and according to Wall Street veteran Tom Lee, we're still in the very early stages of this run. Tom Lee is the same analyst who called Bitcoin's 100x rally back in 2017, and now he believes Ethereum will follow a similar path. He says the market is massively underestimating how big Ethereum can get, pointing to adoption, liquidity, and network strength that rival Bitcoin's 2017 setup. In his view, Ethereum could easily 10x from here and potentially much more. Despite skeptics saying Ethereum is too slow, too expensive, or too old, the charts are proving otherwise. ETH has been outperforming Bitcoin in recent months, developer activity is hitting new highs, and institutional demand is finally starting to pile in. For Lee, this is the perfect storm that could launch Ethereum into its own generational bull run. In this video, I'm going to break down why Tom Lee believes Ethereum is still early, how the market is setting up for a vertical move, what levels Ethereum could realistically reach, and why this run could be the moment Ethereum finally takes its place as the most explosive trade in crypto history. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's hear from Tom Lee first.
How big could ETH get? I hate the term market cap because it's not applicable. Your company has a market cap. ETH doesn't have a market cap, has a market size.
It has a network value.
What is the current value of all the ETH in the world? How big do you think it could get? Because working backwards, that's what the 5% stake in ETH, right?
Mm-hmm.
Okay,
yeah.
so what do you think?
It's about 480 billion right now of fully diluted network value.
Okay.
But
is the supply contracting or not yet?
It's actually growing about 1%.
Growing
which is
1%.
slower than Bitcoin's inflation rate.
Okay.
It's actually a third of Bitcoin's inflation rate.
Okay. How big do you think that could be?
Well, I think that there is a very high probability, I'm going to say maybe even 50%, that Ethereum's network value will flip Bitcoin's.
Wow.
Like when?
The flippening.
Maybe in a couple years.
Tom Lee argues it is still in the early stages of what could be its most powerful rally. According to him, there is close to a 50% chance that Ethereum will eventually overtake Bitcoin in total network value. In crypto circles, this moment is often called the flippening, and Lee says it could realistically happen within the next few years if current trends hold. Today, Ethereum's fully diluted value is about $575 to $580 billion. By comparison, Bitcoin's is around 2.3 trillion. That gap may look wide, but Ethereum's supply dynamics are already creating a strong foundation for catching up. Its inflation rate is roughly 1/3 lower than Bitcoin's thanks to staking and the burn mechanism introduced in EIP 1559. At times, the supply has even turned deflationary, meaning fewer coins exist over time. Scarcity mixed with rising demand has historically been a recipe for exponential repricing in digital assets. Ethereum is also distinct in its use cases. While Bitcoin is seen primarily as a digital reserve asset, Ethereum is the infrastructure for decentralized finance, stablecoin settlement, NFTs, and application development. Every transaction adds activity to its economy, strengthening its network value in a way Bitcoin does not replicate. Lee argues this is similar to how gold was once the anchor of value but eventually gave way to financial systems that could build on top of it. Ethereum, in his view, is setting up for the same role in the digital economy. Institutional activity is already backing that thesis. Bitmine, where Lee serves as chairman, has acquired more than 833,000 Ethereum near the $3,500 range, making it the largest corporate Ethereum treasury. That kind of positioning signals confidence that the flippening is not just a theory, but a potential outcome worth betting billions on. Ethereum may be worth over $500 billion today, but if the flippening plays out, its total market value could be measured in the trillions, restructuring dominance in crypto and changing how investors define digital wealth. With that being said, let's hear how Tom Lee supports his thesis further.
At that time, there was $4 of Ethereum per share, and the stock was $4.50.
So no premium, effectively, almost no premium.
Yeah,
okay.
That's right. And then we've used capital markets, like brought in institutional investors subsequently, and then bought more Ethereum. So
You sold them new shares of stock, secondary offering?
that's right.
Okay.
That's right.
got
And
it.
that includes Kathy Wood and Bill Millers. And so last week
I don't remember you calling me, but okay. Continue.
Yes.
We can talk about that later.
Yes.
Okay.
But last week there was an updated registration statement filed, so you could calculate how much Ethereum was held per share, and it was $35 per share.
Okay.
So the stock, you had $4 of Ethereum per share on June 30th, and then last week at the registration statement, it was now 35, and the stock was trading at like 1.5 times, because the stock was, let's say, 50, 1.5 times its Ethereum held. But when you bought it on June 30th, it was trading at 0.2 times where the Ethereum would be in a month later.
Okay.
Now, all of that was financed with equity, mainly institutional investors. There's the only debt on BitMine's company is $1 million loan that was originally there on June 30th. So the company but everything, its first principle is it's literally straight, clean equity.
BitMine raised about $250 million from groups like Founders Fund and Stan Druckenmiller. Back then, every share only had about $4 worth of Ethereum behind it, while the stock itself was trading at $450. That meant buyers were basically getting ETH exposure at no extra cost, which is exactly what caught the attention of serious money. A few months later, things looked very different. More investors came in, including Kathy Wood and Bill Miller. The company filed new paperwork that showed each share now carried $35 worth of Ethereum. The stock price moved too, trading closer to 50. Someone who had bought in June when there were only $4 of Ethereum per share now held almost 9 times that amount in backing. What makes this stand out is how it was built. There's almost no debt. Aside from one small $1 million loan, everything was funded with equity. That means the company wasn't leaning on leverage to grow. It was a clean balance sheet. And that made it easier for institutions to step in. Tom Lee points to this as proof that Ethereum is moving into a new phase. It's not just traders buying and selling coins anymore. It's companies and funds stacking Ethereum in a way that Wall Street understands. Shares, filings, and balance sheets. The jump from $4 of Ethereum per share in June to $35 just weeks later shows how fast this can scale when capital markets get involved. For Lee, that's the kind of setup that could push Ethereum's value far beyond where it is today.
So Ethereum, number one, is where the stablecoin boom is taking place. 60% of it. So like this whole Genius Act, Besant says stablecoins are going to go from 250 billion to 4 trillion. That's an exponential demand growth for Ethereum.
They're replacing money market funds.
Correct. And it's dollarization and all that. Ethereum pays a 3% native yield if you stake it. So the 6.6 billion held of Ethereum is over $200 million in net income right now. The day we turn on staking, not only is there no debt on Bitminer, it's going to pay you $200 million a year in dividends.
And what do you do with that? Buy more Ether?
Or we might just pay it out as cash dividends.
Where does that 3% native yield come from? Is that gas fees that users are paying to use ETH?
Well, it's called proof of stake. So Ethereum doesn't have a proof of work model where you're competing for a block reward. It's saying if you hold ETH and you agree to stake it and validate transactions, you earn the staking fee, which is 3%.
Okay. So that's where that's coming from.
Yeah. And then there's a power law force at work that if we get to 5% of Ethereum, we become a really benevolent staking entity. That's why we want to get to 5%.
The market for stablecoins is around $250 billion today. Some analysts think it could grow to $4 trillion. If that happens, most of that growth will run through Ethereum. That is a huge demand shift. Ethereum also gives a yield when you stake it. The rate is about 3%. BitMine holds more than $6.5 billion of Ethereum. That means staking would bring in over $200 million every year. Since the company has almost no debt, it can use that money to buy more Ethereum or pay it out as dividends. Either way, the return is real and steady. Understanding staking yields and economics on Ethereum and Solana. The way staking works is simple. Instead of miners fighting for rewards, people who lock up Ethereum help run the network. They validate transactions and keep the system secure. For doing this, they get paid. The money comes from gas fees that users pay when they use Ethereum. Tom Lee wants BitMine to own around 5% of all Ethereum. If that happens, the company would be one of the biggest investors on the network. It would earn more yield and have a stronger part in keeping Ethereum safe. For Lee, building toward that number is not only about holding Ethereum, it is about being part of the system that millions of people and trillions of dollars may rely on in the future. That covers how stablecoins and staking already make Ethereum valuable today. But the bigger picture isn't finished there. To see where this can go, we need to look at its supply, how institutions are lining up, and how it could become the backbone of global settlement. Ethereum's lost supply reaches a staggering 913,111. ETH Bitcoin is known for its hard cap of 21 million coins. That cap never changes, and for years it has been the main argument for Bitcoin's scarcity. Ethereum doesn't have a fixed cap, but since moving to proof of stake, the way its supply works has changed in a big way. Each transaction on Ethereum now burns a small piece of Ethereum. Once burned, that Ethereum is gone for good. At the same time, staking removes coins from circulation because they are locked up to help secure the network. With burning on one side and staking on the other, new issuance slows down. The result is that Ethereum's annual growth rate has dropped below Bitcoin's. In active periods when network use is high, the total supply can even shrink. When the merge first went live, Ethereum's supply dipped into negative territory. For months, more Ethereum was being burned than created. This did not happen because of speculation. It happened because people were using the network, paying gas fees, and driving activity that pulled coins permanently out of circulation. Bitcoin does not change with usage, it keeps releasing new coins on a fixed schedule. Ethereum adjusts in real time. The adjustment is not always deflationary. When fees are low or staking rewards rise, supply can still grow, but the rate is a fraction of Bitcoin's. In fact, analysts tracking issuance found that Ethereum's inflation has often been 1/3 that of Bitcoin. That dynamic gives Ethereum a case for scarcity, even though it doesn't have a hard cap. The takeaway is clear: Bitcoin's supply is fixed, but Ethereum's is living. Every spike in demand makes Ethereum harder to find, and if adoption continues, scarcity is going to hit harder than most people expect. Supply alone doesn't move prices, demand has to show up. That's where institutions come in. The last cycle proved what happens when Wall Street opens the gates. In 2020, companies and funds poured into Bitcoin through public companies, trusts, and later ETFs. That flood of capital pushed Bitcoin to new highs. Ethereum is now standing in front of a similar moment. Now, the talk among fund managers and analysts is not about whether Ethereum products will launch, it's about when. Spot Ethereum ETFs are waiting for approval, and regulators are under pressure after green-lighting Bitcoin ETFs. Once those doors open, the amount of money that can flow in is enormous. Corporate treasuries are also beginning to take notice. MicroStrategy became a case study for Bitcoin by raising billions and stacking BTC on its balance sheet. Bitmine is trying to play that role for Ethereum. By building its treasury through equity financing, it gives institutions a clean way to buy Ethereum exposure. Investors who wouldn't touch a crypto wallet are comfortable holding regulated shares. That structure turns Ethereum into something pension funds, endowments, and family offices can actually allocate to. The difference this time is that Ethereum isn't just an asset to hold. It has yield through staking, and it powers networks that institutions already watch closely, from stablecoins to tokenized assets. That combination makes it easier to justify Ethereum in a portfolio, not just as a speculative bet, but as infrastructure. Bitcoin showed what happens when institutional FOMO sets in. Ethereum is next in line, and this time the ceiling is higher. Institutions give Ethereum legitimacy, but the reason they want exposure runs deeper. It's not only about holding an asset. Ethereum is already becoming the rails for digital money itself. Right now, most stablecoins live on Ethereum. That includes USDT, USDC, and others. These tokens are the bridge between the crypto world and the dollar system. People use them for trading, payments, and savings. The numbers show how big this has become. Hundreds of billions of dollars flow through stablecoins every month, and the share on Ethereum is dominant. If forecasts of a multi-trillion-dollar stablecoin market come true, Ethereum would be the primary settlement layer for that value. That makes Ethereum not just a currency, but the infrastructure that supports dollarization in crypto. DeFi adds another layer. Lending, trading, derivatives, and countless other financial products are already running on Ethereum smart contracts. Billions in value are locked in these protocols. Every one of those transactions uses Ethereum for fees. It happens daily, and it ties Ethereum's value directly to real financial use. Tokenization of assets is beginning to enter the picture too. Banks and payment companies have started experimenting with issuing bonds, treasuries, and even real estate titles on Ethereum. When these trials move into full production, the network won't just carry stablecoins and DeFi, it will also carry traditional finance. That means a single blockchain could end up processing activity once reserved for Wall Street clearinghouses. This is why Tom Lee sees Ethereum as more than a speculative play. The network is positioning itself as a global settlement engine. It can settle stablecoins, run lending markets, and even secure tokenized securities all on the same chain. The more activity it carries, the more Ethereum gets burned and the more valuable it becomes to hold. Ethereum's upside is not limited to its market cap today. If it becomes the default layer for global money movement, the scale will be measured in trillions. And if that happens, the current price will look small compared to what comes next. If Ethereum really is on the path Tom Lee describes, keeping up could be the difference between catching the upside early or missing it completely. So if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.